If you're following the mortgage rates because you know the impact your borrowing cost, you may be wondering what the future holds for them. But unfortunately, there's no easy way to answer that question because the mortgage rates are notoriously hard to forecast. But there's one thing that's historically a good indicator of what will happen with the rates, and that's the relationship between the 30-year mortgage rate and the 10-year Treasury yield. Here's a graph showing those two metrics since Freddie Mac started keeping mortgage rate records in 1972. As the graph shows, historically, the average spread between the two over the last 50 years was 1.72 percentage points, also commonly referred to as 172 basis points. If you look at the trend line, you can see when the Treasury yield trends up, mortgage rates will usually respond, and when the yield drops, mortgage rates tend to follow. While they typically move in sync like this, the gap between the two have remained about 1.72 percentage points for quite some time. But what's crucial to notice is the spread is widening far beyond the norm lately. If you're asking yourself, well, what's pushing the spread beyond this typical average, it's primarily because of uncertainty in the financial markets. Factors such as inflation, other economic drivers, and the policy and decisions from the Federal Reserve are all influencing mortgage rates and a widening spread. And why does this matter for you? This may feel overly technical and granular, but here's why home buyers like you should understand the spread. It means that based on normal historical gap between the two, there's room for mortgage rates to improve today. And experts think that's what lies ahead as long as inflation continues to cool. As Odetta Kushi at First American explains, it's reasonable to assume that the spread and therefore mortgage rates will retreat in the second half of this year if the Fed takes its foot off the monetary tightening pedal. However, it's unlikely that the spread will return to its historical average of 170 basis points, as some risks are here to stay. An article from Forbes, though housing market watchers expect mortgage rates to remain elevated amid ongoing economic uncertainty and the Federal Reserve's rate hiking war on inflation, they believe rates peaked last fall and will decline to some degree later this year, barring any unforeseen surprises. If you're either a first-time home buyer or a current homeowner thinking of moving into a home that better fits your needs, just keep an eye and keep on top of what's happening with the mortgage rates and what experts think will happen in the coming months.